We had a lot of movement going on in the markets today. We got a lot of stuff to go over, especially with that yen. Man, the yen moved phenomenally crazy. Tell me, was anyone in the chat, looking at this thing or trying to trade this thing over the last 24 hours and not listening to Mr. Weston Nakamura? Oh man, Weston, again, one of the better analysts when it comes down to yen and the FX markets. And man, he had perfect pinpoint timing on his calls. Oh man. Alrighty, we got some extra music going. Everything is sent in the Discord. If you want to come hop in the Discord, I got this set up here. We'll be hanging out in the Discord after the stream is done, and if anyone wants to come on the stream when there's a shot, you can come and raise your hand in there in the stage. Otherwise, I'll just be focusing on the YouTube stream, the YouTube chat. Alrighty, let's get into this. Western Nakamura heads up on the yen. Now, he did post this Substack here. I did get the email notification of this Substack first, actually, before he sent out this tweet here, or what is it? Just call it post now. I think they're not called tweets anymore, just post. Now it's on the X platform, right? All right. Here's the killer. Essentially, if USD yen continues to fall, yen futures continue upside and then breaks meaningfully through the strike at 68.5. I'm leaving out the OOO prefix on yen futures. That may trigger a relatively small gamma squeeze on the dealer side, but that small gamma squeeze can push yen futures right into the 69 level, where there is serious sized call open interest of nearly 10,000 contracts, approximately $850 million notional worth of options contracts. So apparently there's like $1.7 billion worth of these options contracts expiring end of week this week. And yeah, you can see right here, this is what he's checking out, these big spikes here. Like, wow, huge spikes. You can see the 69 level right there. I'm trying to circle, yeah. And those are the big green spikes just in the whole order of things. Let's see here. This is one single trader, by the way. I've been following this position since mid-November, when suddenly both positions were opened from zero open interest prior. So this looked like totally gray, totally kind of flat, pretty much no trading, and then bam, like hundreds of millions of dollars bet, apparently, because he's the one who said he's watching this. For anyone whose eyes are glazing over from the options talk, my apologies. Basically what I'm saying is that if yen futures get through that particular price, it can easily go to the next level. If it does, yen can seriously rip higher. So USD yen plunge. Let's go ahead, open up that chart. Yeah, you can see that plunge. All sorts of crazy move. Ain't that a tail risk? Yeesh. That is nutty. And this is the sort of thing that people have been saying, guys, you got to be careful, because you get one or two, and this isn't like the Ministry of Finance or the Bank of Japan or any super huge change in the economic outlook. This is traders and people participating in the markets, and they had to move a lot faster than people might have originally expected over this period of time here. And that was fast, man. That was like 550 pips. That was crazy. Crazy. That was just in the last 24 hours. Just in the last 24 hours, we got that. Wow. And we're starting the stream today at the opening of a new day, so we're going to see if this thing follows through. I think that's probably going to be your low. I think that's probably going to be well supported. This, based off what I'm reading here from Nakamura's research and looking at on the chart, from what I understand, what expectations I have now is that this was just a plunge. A bunch of money had to get shifted around, and now this is essentially declared a jump in price. And yeah, we'll still probably see. Oh, that's a kind of a weird thing that just happened. Moved my chart indicator to like a lower panel. Anyways, yeah, this is just a jump. We'll probably still see potentially negative drifts, but I don't know. This doesn't look. I mean, I'm not trading, and I'm not interested at all in participating right now until there's a more clear and thorough understanding of what the expectations are going to be for this asset for the rest of December more easily. Because now that this event has occurred, everyone's going to be updating their expectations and their forecasts and trying to decipher what happened. And a lot of them are going to be reading this Weston Nakamura article to try and figure that out. This can cause global cross-asset mayhem, though if it does, would likely be temporary. Oh my god, it's almost like I... But yeah, so of course, if you were trading this and got hit, those are hits you're gonna have to live with. But yeah, I'm like, my initial impression is, yeah, it'll probably be temporary. Now, whether or not it comes and makes a new high on the month, I don't know if I'd take that shot. I think that might have been a super huge overextension, and that probably would be the low for the month. But you know, who's to say this can't happen again in like another week and a half? So it's just a matter of being diligent. And what's interesting is that this particular Weston Nakamura article also came out at like 12 hours ago. Came out 12 hours ago. Before like the huge runoff. If we go to, let's say, the 30-minute chart here. Yeah, right around here is when the article got released. So it had already fallen a cliff here, and you can even see this is the screenshot of the fall off going on here. And he's saying, hey, watch out, this thing can spike again lower. And then yeah, there's the spike. Let's see here. I'll follow up with Weston's video a bit later, but I'll leave it like there. And let's keep moving along here. Stuff coming up around the corner here. So let's go to the euro dollar. Actually, before we start going into euro dollar, I did some commentary yesterday in the trade group demoing out these indicators, and I got a request to do pound yen. And I was like, you know, pound yen looks a bit different compared to all these other yen pairs, in my opinion. Because I'm looking at this low distribution right here, and I'm also looking at these low pivots. Now, maybe when I turn on the pivots, this looks a bit more obvious. I was like, yeah, you know what? It's either the low for the month comes in around this central pivot S1 area right here, or you risk getting a spike down here. And I was like, you know, I don't know what would cause that. And this was yesterday. I'm like, I don't know what could cause that, but if things started moving, I would almost start anticipating and doing more careful and rigorous and frequent research on trying to figure out, like, is this now a more realistic possibility because we're moving lower here? This is over the last 21 years of data where the low for December shows up. So that's where I'm also coming in and saying, like, you know, I think maybe the low for here could be in now. But it really can go low. It really can move around a lot more significant. Just because it's moved down here and there's a peak, right? So it's like, oh, most of the time you get your low here or here, nominal. Those are some nominal set of expectations, especially bullish and kind of range bound-ish. Maybe this is your bearish target. This spot right here, this is like edge case. That's a moderate density bump before you start going off into like the real tail of that distribution. But once price starts moving like past here, it's like, oh man, you got to be careful about potentially going to a higher density spot on the distribution further down. And that's where you leave the chart and you stop looking at the statistics and you start trying to actually figure out what is going on in the market. If you're not able to interpret why things are moving and you weren't already expecting this sort of move, like Weston was, right? He has the expert advice and the expert research that he does and that he has to kind of be aware of, hey, there's this tail risk scenario of a gamma squeeze on these options contracts that we got to be aware of. I mean, I would know to do that for the end contracts. I'm not looking at that particular part of the market, right? I'm trying to build out some of these models and whatnot. But man, that's why I go out of my way to do stuff like read Weston as soon as he posts stuff. As soon as he posts, I'll go ahead and try and get his content read. But pound yen looks a bit different from all the other ones because you don't have that similar peak at the far edge, right? That was euro yen. I mean, you have maybe something there. That's kind of nutty. This is Aussie yen. Like, they all look different because they're all different assets. But that pound yen, and then also if you bring this up, you can see just you don't get these sort of tail moves frequently. Like over the last 18 years, we have data for CAD yen. Only moved down below this S1.5 pivot point on the monthly scale 2 times before. 2 times. So the frequency from the seasonal data might not be enough to make great decisions, but like, yeah, once you start moving past that S1.5, like, you can see your odds start getting really small right around, call it 106 here on CAD yen. And then you pull up these pivots, there's S1.5, it's priced at 106.5. So it's like roughly this area. It's like you're starting to trade in a spot where this is like falling knife gambling territory. And it doesn't necessarily mean you can't make money here, but this is usually where people like lose their shirt. This is the area where people frequently lose their shirt in trading. Like, they go long around here, right? And they buy, and they don't say like, well, what's like a reasonable place to stop participating in this market, right? They have no idea of risk parameter, right? Well, being able to look at the distribution of all your outcomes can help figure out, that kind of the spots where you might be interested in, the spots where you might not be. You can take into account the statistics as much as you want, But if you don't actually understand what it is you're trading, when this stuff happens, like the statistics go out the window, right? That's why reading the outlooks and doing the research is just so freaking important. Ran out of the way. Let me go ahead and move on over to the ECB stuff we have coming up here. So this is the euro dollar. This is the weekly range here. Looks good. Yeah, it's like right at the edge there. I would not be surprised to see, what is that, 107, 1072, like this spot here. I would expect another one more dip and then like a super hard rally into end of month is my current expectation based off what I've been reading from all these different outlooks. Like, man, again, from the last stream I did, so many institutions are so pissed that dollar has been getting so strong during this first week here, because a lot of them were taking long shots right here, right? A lot of institutions were taking long shots. This guy hit. And they're still looking at the data and they're like, even though we got hit, even though we lost on these euro dollar longs, we still have positive expectations for this thing going into the end of the month. When they go ahead and they review the data, like, none of the data has changed, even though we understand why this has moved lower now, which is, inflation data out of Europe came in lower than expected, which is making the ECB less hawkish. It's making them more dovish. And so the rate of change for the euro is now not as significant hawkish on the rate side of things. So now the difference between rate hike expectations over the course of 2024 for the euro is now not as significant as it once was against the US dollar. Meaning, hey, let's pare back some of these more long euro dollar trades because we don't have as bullish expectations for rate hiking odds going into, let's say, the first half of 2024. That's effectively is the roundup of the pullback here. But between now and the next major ECB meeting in 2024, this meeting will still be important. We're going to be going over some research on it here from Nordea. Check this out. The ECB cannot disregard the latest developments on the inflation front, I believe, when it communicates the outcome of its latest meeting on December 14th. Even one of the more hawkish members of the governing council, Isabel Schnabel, I don't think I said that correctly at all. I'll just say Isabel, right? Called the changes in the core inflation outlook quite remarkable, quote unquote. Though she added the ECB should not declare victory over inflation prematurely. A few other hawks, in turn, have talked against cutting rates in the first quarter or the first half of next year, illustrating there are likely to be many different views in next week's meeting. And you can see here the chart of core inflation. You can see it's falling, the rate of change, but it's not making Nordea saying, hey, how strong of an opinion are these hawks going to hold on to their strong opinions, right? How durable is it? What are some of the new types of data we would have to see to actually move their opinion to be less hawkish? And Nordea is saying, well, it's kind of going back and forth right now. They're at a point where if inflation really does like take another hit come for the December and the January data, they'll probably end up moving and probably end up cutting in the first half of next year. you know, a lot of market pricing for these ECB and FOMC rate hikes are all expecting first half of next year rate cuts to start. I think March, if I'm not mistaken. In March for the FOMC, there's pretty high odds now of a rate cut coming in here. Let me go ahead and pull up the CME groups thing. So here's March. So the current is at, 525 to 550 basis points, and 53% probability price based off the futures pricing, right? It's not options. There's other ways of pricing this particular model, but based off the model CME group publishes, very easily accessible for me. 53% rate hike cut for for March. You go out to May and it's probably what? Yeah, it's more like 80% by May, 50% by March. You go ahead and you get the December data out, and you're talking FOMC starts potentially cutting more. Those odds in March might continue to rise. A month ago, we had 22% probability in this bin right here. And a week ago, it was 41%. Now it's 53%. Wait until the data for December comes out and the next FOMC meeting and the next ECB meeting comes out, and we'll see how the reaction and the commentary out of the central banks, if it actually sways market pricing, or, you know, it'd be hilarious. These central bankers, if they come out and they're like, oh man, we're going to stay as hawkish for as long as we possibly can. Yeah, we're making great progress on inflation, but we're going to try and stay as hawkish as we can. And then the market pricing, the probability of these rate hikes coming in, like during February to April for all these major G7 central banks, just keeps ticking on higher. Like, oh, another 5% that week, another 5% the next week. By the end of January, it's like, oh yeah, a 70-80% probability that there's a rate hike of, or a rate cut, right? Misspoke there, a rate cut by like February to April, depending on the central bank you're looking at. It could be rather interesting, you know, start off for the new year. That's for sure. Let's keep going down here. Economic outlook remains dim, with PMIs also suggesting deteriorating labor market. Yep. Output prices are holding up a bit. Employment, yeah, that doesn't look good. Production is up and new orders are up. And hopefully that is just a cyclical low that came in. So hopefully those things start to pick up, and then you see a follow through in employment. But we'll have to see. We'll have to be cautious, because you don't want that unemployment staying too high for too long. Oh man, I mean, a lot of businesses are gonna have to. A big risk in 2024 is if rates are not cut sooner than expected, than from the official central bank policies are stating. If rates are not cut sooner than the official policies are stating, and closer to what the markets are expecting, I think Bill Ackman actually kind of put it quite succinctly that all these businesses that use debt to finance a lot of their business activities, to acquire equipment, to pay for employees, and to get their business running so then they can go and get the money. They are very used to having lower yields on that debt. But now, because yields are, you know, just XYZ bond or yield or loan, you're going to be paying more than 5%, just more than 5% for that debt. Whereas before they were paying maybe less than 3 or 2, depending on what you were doing with it. So you're going to be, for the same amount of debt, you're going to probably be doing less with it on your business. And you listen to Bill Ackman and a few other people who are in similar positions to him, like the people in the All In podcast. I don't know if it's a little bit of concern trolling, like, hey, our companies have particular financial problems that we're looking at when it comes down to these yields going out into 2024, and we really hope that those yields become at least a bit more affordable. We'll see we'll see if the rate of change of growth is more or less maintained, or if we actually start to take significant hits, if that yield component is actually that big of a deal. If you have especially tight margins, like, for example, Walmart, that it's not going to be easy for like a Walmart that already has super tight margins, because you increase the yield on the debt that they take to go out and buy a bunch of product by like 2 or 3%. Now they have to increase the prices of all their product in order to maintain their margin, just to maintain their sales, and then that could potentially induce a reacceleration in inflation, as you're seeing a rise in real rates. Like, I can see why the market's trying to say to all these central banks, consider rate cuts. Man, we've been going on for 30 minutes and I've only gone through one outlook. You can see I have like 20 tabs open of all this different research, and a lot of it's actually based for New Zealand. But let's not get off track here. 3 scenarios Nordea identifies for the ECB, that meeting that's coming up here in December. We think uncertainty around the outcome of the December monetary policy meeting has increased, even though rate cuts are still off the table. We present 3 scenarios on what the ECB should communicate next week. For the hawkish scenario, the ECB repeats the rates need to remain at the current levels for longer, and new inflation forecasts suggest inflation will remain above the target for several more years. Lagarde could even comment that the current market pricing is overly aggressive, right? Market pricing of when the first rate cuts are going to be coming in, compared to the ECB's current thinking. Oh my god, it's almost like I somewhat know what I'm talking about with my commentary. This hawkish scenario implies that the ECB is not close to starting the discussion on rate cuts yet. And that would imply maybe rate cuts getting pushed out to the end, to like the beginning of the second quarter, end of the second quarter. It probably would maybe move market pricing by 1 or 2 meetings, not like 3 or 4, into like the second half of next year. People are pretty dead set on like, okay, sometime in the first half of next year, we are expecting rate cuts. That seems to be the consensus expectation. Baseline scenario, the central bank turns more dovish on the back of soft inflation data and the weak economy. This seems reasonable considering they just pointed out that PMI on the employment side of things. And forecasts show inflation is in line with target as early as late 2024, but stops short of suggesting immediate rate cuts. Such a message would make a rate cut at the next forecast meeting in March more likely. And that's where, right now, pretty significant pricing for the FOMC in May. But yeah, if this sort of commentary came out, yeah, it would potentially make Eurodollar sink again. Eurodollar could sink again, even in this baseline scenario. Let's go ahead and pull up the distribution of lows for the month. Where's the data? Am I loading like 50,000 simulations or something? Oh no, that's just the closing data here. I mean, it's just load so much data into these indicators that they refuse to load. Oh man, okay. We don't want another yen experience, another pound yen experience to surprise us, do we, guys? We don't want another pound yen experience to surprise us, now do we? Look, if this sort of scenario occurs, or they just full out go dovish, like, I think that becomes a more reasonable valuation target. Under especially this dovish scenario. However, I don't think that maybe 5%, 10% probability they have that dovish scenario. Like, that is the smallest, like, there's more likelihood that they go with this hawkish phrasing at their meeting than this dovish phrasing. Like, because this would completely contradict what they've been trying to push for like the last 2 years. This would be like a total 180, and yeah, that I think that might justify this peak in the distribution, reaching that for the low on the month. I mean, we just identified 2 tail risks back to back with that pound yen and now this euro dollar, man. That ain't so hot. That ain't so hot. Yeah, sometimes it's not so easy. Alrighty, let's see here. Dovish scenario. The ECB comments that recent inflation readings have materially changed the outlook, which together with weak economic development calls for gradually lower rates. New forecasts suggest downside risks to the ECB's 2% inflation target. The topic of rate cuts was already on the agenda at the December meeting, suggesting rates could fall as soon as the July meeting if December data confirms the new baseline assessment. Alrighty. We think the middle scenario is the most likely of the 3. Absolutely agree. And if this scenario is realized next week, we will most likely change our baseline call for the ECB, moving the first 25 basis point cut from June to March. Yeah. Same expectation. I don't know if that would be enough to move you all the way down here, but I think B of A is going to be very upset with, like, oh my god, we're not going to hit one. Like, B of A had a euro dollar forecast of like 115 by end of December, I think. And now we're here sitting at 108, and we're looking at this research saying, yeah, it's not, it'd effectively cap euro dollar at like 110, this phrasing here. Let's see here. Financial markets are currently mostly pricing in a 25 basis point cut for March 2024, while around 3 basis points of cuts are still in the January meeting. All right. Okay, still, given the current momentum, the fact that even the middle scenario could mark a notable change in the stance of the ECB, rates could fall a bit further. Also in the middle scenario. So they're actually saying there's potential surprise here for yields to fall further, even in this scenario, that the markets would interpret the baseline scenario more skewed to be similar to this dovish scenario, however, not as, like, turn around the world upside down if they actually did this. Let's see here. Inflation expected to be back at the ECB 2024. Gotcha. This is pretty far out. Let's see here. Given the PMIs have continued to be clearly below the level of 50, and it is hard to see how the economy could suddenly pick up, we think that the development will continue to be sluggish in the first half of 2024, and the ECB will also lower its economic projections. This could imply that both 2023 and 2024 GDP projections would be at around 0.5%, and then reaccelerate to above the 1% threshold in 25, 26, etc., when the ECB probably expects GDP development to recover and growth rates to remain above the long-term potential. Gotcha. The low growth forecast will lower the ECB's inflation projections considerably for the next year, which implies that inflation will be back to the ECB's target in the course of the next year. That is particularly a dovish expectation in my interpretation. PMIs continue to be weak and indicate a mild recession to take place in the euro area. Again, sub 50. We're just looking at how these numbers look at the sub 50 mark. They do seem to be ticking up, especially the manufacturing, but composite and services, they need to have a jump higher before there's any sign of hope. Let's see here. I don't know, maybe second half of 24 is reasonable to see a more cyclical return in PMI growth above 50. A stable return above 50. Macro and markets, this is another Nordea one. And now this is talking about the FOMC. Does the US need a rate cut in March? So what a difference a month can make after we believe it will take much longer before the Fed can be convinced that inflation is truly under control. With the US labor market still very much on a strong footing, the US financial conditions now on the easy side, it will not take much for the economy to start firing up again. Okay, so this is like the flip side of a particular theme going around in market research. This idea of relative G6 outperformance against the United States, or United States outperformance against the rest of the G6. And it seems like Nordea is now on the side of, hey, we might want to start looking at the side of US outperformance of the rest of the G6 in this particular scenario, because if the Fed holds and they start communicating, hey, we are considering more significant hold on our rates, that could make the US dollar stronger. And as rate cut expectations in the rest of the G6, G7 start coming out, and it's like the reverse of that theme from back in October around relative G7 or G6 growth and inflation outperformance relative to the United States. And that was a big talking point around the expectation of all this risk on coming through into the end of the year, which, a lot of institutions went ahead and they took their shots here on these pullbacks, and then when the follow through did not actually come and follow through, now it's like, oh, maybe we need to do a little shifting in our seat here. I mean, I'm just having fun with my commentary, right? I'm just a guy on YouTube reading through a bunch of other people's really hard work and doing interpretations with my own tools here. So, you always take my views and expressions with a grain of salt, right? But I go over this information to just try and make things generally accessible to, hopefully a larger, more informed audience, right? Let's go ahead and check out if there's any other new information. Oh, also, FYI, we yeah, remember, you can always get these. You can always get these indicators, which is the probability pivot points, the range probabilities. You can get all these actually for free. You can get a 10-day free trial here. So you don't actually have to commit to get these things here. And all the research that I talk about, that's all publicly available and freely accessible. Made freely accessible by the institutions that share them. Just go ahead and check out the Outlook's channel in the Discord. And if you want to hop in the Discord, there's actually a join the Discord option right here. And that is completely free. All right. Let's see here. So they're looking at some stuff. So this is pricing for the Fed. This is currently what the curve for Fed funds look like right now. Yeah, it looks like as soon as the next meeting is over, cut is expected in the market forwards right now, but I'm not totally sure if we're gonna get that. Let's see here. We expect their new economic projections to revise the outlook for inflation lower, but higher for Jonesy will remove the additional rate hike and still call for 50 basis points of cuts next year, far less than the 125 basis points that the market is pricing in and calling for. If it will be a big enough wake-up call for the markets is still unknown. So if the Fed's opinion will actually change the market's pricing is unknown. Still, it at least the sixth time the market is pricing near-term rate cuts in this cycle. We are not sure they have gotten this time right either. Yo, James, saw your message here. Man, we've been going for a good while now, a good 40-ish minutes, and I don't think we're close. We're not close to done at the moment here. We got quite a bit of research to go through. Williams, one of my favorite analysts to read. I believe he's the chief economist. If I'm not, yeah, chief business economist, S&P Global. This is the guy in charge of making sure the PMIs look right. This guy's in charge of effectively making sure, like, when you read stuff on the PMIs, he's essentially the guy, he's the boss when it comes down to the PMI stuff. I'm the boss on this channel and I'm the boss on this stream, but he's the boss of the PMIs. Globally, output price inflation edged higher in November, according to PMI data by S&P Global. Importantly, the surveys indicate that the overall demand environment remains subdued, and global demand pull price pressures have now consequently fallen close to their long-run average. Employment growth has meanwhile stalled as firms grow concerned about excess capacity, which should cool wage growth. All right. And then we can go ahead and check this out here. PMI selling prices, potentially as a leading indicator of consumer price index. So they're actually saying, hey, if we extrapolate this PMI selling prices, goods and services index, it generally leads US CPI year over year by about 6 months. So reasonably, S&P Global is expecting lower year-over-year CPI for the United States because of that. Bum, 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 bum. All right, services inflation edges higher. Gotcha. Looking in more detail at the broad industry level, consumer services and healthcare reported the joint strongest rise in prices charged during November, followed financial services. The softest rate of inflation was seen for basic materials, which is a sector that has suffered especially weak demand in recent months, followed by consumer goods. Yeah, commodity prices. Have commodities been holding up? Relatively speaking, it seems. How about copper? Copper has been on a pretty negative trend all this year. And oil, of course, we know it's been just taking massive hits. Oil is not in a good spot here right now. That is a hard hit here on oil. Yeesh. Yeah, this is like gambling territory at that point. But man, it's just been straight down. I wonder if it has anything to do with OPEC. If anyone has actually been following the OPEC stuff. Oh my god, it's just been so nutty. They're like, well, we're probably gonna have to continue cutting. And all these inventory buildups are starting to come through. Like, it's for nat gas especially, it's not looking so hot. And that spike, yeah man, that is a crazy spike. I mean, whenever these sorts of spikes occur, you just either want to, you know, pray that it goes in your direction, like you're already long and the spike comes up and you're like, oh, all right, I'm just gonna walk away. You know, it's like it's like being the person with the type of diligence. One sec. All right, let's get back to work here. I believe a big seller has entered the market. Yeah, I got no clue when it comes down to what happened on that gold thing. I mean, it looks like a fat finger to me. Like, obviously, 1 or 2 or 3 people came in and were like, time to buy up as much gold as possible. And that obviously was the wrong decision. Or it was a bunch of derivative options that were forced to exit. And in forcing that liquidation, they were forced to buy back gold to fulfill the delivery on those derivatives. That could be a problem. Stuff like that happens so actually at a fairly regular basis, to be frank. Derivative shenanigans. But then again, if someone might have already figured out why that spike happened. I have not read anything on my end about why that spike occurred. Oh, let's see here. Wage pressures remain elevated globally, but demand pull price pressures weakest. There we go. ECB and FOMC inflation signaled close to target, but stickiness seen in the UK. Looking at price trend variations around the world, the stickiest inflation is evident in the UK, according to the PMI Composite Selling Price Index. A further rise in the... Oh man, people really want my attention today. Eesh. We're having a luncheon party at the moment, and everyone's like, "Where's Joe? Where's Joe?" I'm like, "I'm currently doing my work at the moment. Dude. Give me a break." So let's get through this, all right? A further rise in the rate of inflation suggests headline CPI inflation could stick at just over 4% in the early months of 2024. Man, I actually got through the sentence. Great. All right, let's go ahead and actually get through this here. In Asia, PMI hints at inflation cooling below 2% in Japan in the coming months. That actually is really... I don't know, depending on how you're trading yen or Japanese equities, that might be a good or a bad thing, depending on what you're looking at. Because that effectively means that the Bank of Japan might need to go back to looser monetary policy instead of hiking. So that'd be good for your Japanese equities. It wouldn't be good for your yen and weaken your yen if that ends up being the case, right? Because Bank of Japan wants to start hiking if they see inflation actually starting to become solidified and not having this disinflationary property so constantly that they've been dealing with effectively ever since, I think, the 90s, right? Let's go ahead and move on to the next article. These articles are linked in the YouTube. Actually, it's in the Discord here, and you can get access to the Discord right there. Uh-oh. I think I need to bring up my... Yeah, refocus that. I accidentally, I don't know why Windows does that. I go ahead and I shake around a window and it just hides everything automatically. I'm like, that is not the behavior I want. So here, I'm just getting everything back up now. All right, I think we're good now. All right, we're back. Oh wait, hold on. I need to bring up my YouTube chat. All right, we're good. We're good. Okie doke. Hey, and no, I do not. Sure, I'll accept your cookies, but don't send me little pings. China PMI signals tentative growth revival in November. Prices edge higher for the third month. That sounds like a bit of hope out of China. China is not collapsing yet. China's not collapsing yet. That's the headline. PMI survey data from S&P Global, good old Chris Williamson, and what is it? Kaizen showed the mainland Chinese economy regaining some growth momentum midway through the fourth quarter. Output, new orders, and expectations for the year ahead all ticked higher, with a broad-based improvement seen across manufacturing and services. However, the overall pace of expansion remains very subdued, and business expectations in particular continue to run far below the long-run average, prompting firms to trim their headcount for a third successive month in November. So, similar kind of European and Chinese employment outlook, no? I think potentially so. Let's go ahead and bring up a chart here of maybe the Aussie dollar, because this one reacts quite well. Aussie pretty much reacts very, very closely with expectations around China. So let's have that chart pulled up here. Let's see here. Services and manufacturing report higher output, but growth remains subdued. Yeah, I see what you mean. Improved but subdued confidence. Expectations look relatively okay. Not as high as they were over like the last 2 years, but it seems like we're currently at more nominal levels pre-COVID. Between 2015 and 2020, we're currently at more nominal levels of future expectations. Third month of job losses, that ain't great. But so long productivity stays relatively high, it's just all it is more wage negotiations. They're just trying to not hire as many people and increase the productivity of people that they currently have, so then they don't have to pay new employees so significantly and they're just holding off until the wage inflation comes a bit lower so then they actually can hire those people back. Let's see here, Euro area from Danske Bank, a year of transition ahead. Okay, so this is a 2024 outlook. We expect the ECB policy rate has peaked and foresee 325 basis point rate cuts next year, starting in June, meaning that monetary policy will still be restrictive. Okay, doke. Well, let's see if Danske Bank has to change their mind or not. However, again, even if the ECB just maintains their current policy and they actually move in June, markets are just going to be super aggressive in pricing, and then they'll have their huge volatile swing in like the 2 or 3 weeks leading up to an ECB or FOMC event. If pricing cuts up until that point isn't putting enough pressure on the ECB to conform to what the market wants them to actually do. Sometimes central banks can actually have credibility, guys. Sometimes central banks don't have to constantly give out surprises or say they're going to do something that they're not going to do. Just be so grateful that we live in a point in time where we actually do get these meetings, because it was like 20, 30 years ago that effectively all you're told is, oh, here's the rate decision. Go ahead and figure out why we made the rate decision, guys. Now we actually get a lot of transparency behind the decision-making process of these central banks and why they actually come to the conclusions that they come to, rather than just being left out hung to dry like a lot of people were as far as expectations. Like, there was a lot of surprise. Especially during the 80s and the 90s around central bank cash rates. Like, it is... We have a lot more transparency. A lot more transparency around what their decision-making processes are at these central banks. A stronger belief in a soft landing. All right. We have seen further signs of soft landing in the euro area data recently. They look at the inflation data for that. Overall, also, data out of the US has supported the narrative that the economy has cooled off. However, the Fed itself, including Chairman Powell, has stressed several times recently that rate hikes remain a real possibility and that inflation can still reaccelerate. Yeah, the background like chatter noise. I'm like, who's talking? Who's talking to me? Let's see here. Oil prices have traded significantly lower over the recent month on the back of weak demand. Again, I thought it was demand side, reflecting global manufacturing recession and OPEC failing to agree on further production cuts. This is another tailwind to the near-term inflation outlook and consumers' prospects of regaining purchasing power. Markets are, for now, not suggesting a high risk that the war between Israel and Hamas will spread in a way that seriously affects energy supply. Wow, that is a great, like, little succinct paragraph on oil expectations. And data out of China show an economy where growth is holding up quite well. Yeah, China's not collapsing. Yay! And then that's the Nordic outlook here. Let's see here. Signs of a soft landing have significantly moved financial markets over the last month, sending equity and bond prices higher, as well as credit spreads lower in support of the euro against the US dollar. Well, I don't know about that one quite yet. I mean, when you look at these executive briefings over the last month or two, like, yeah, this was quite a significant rally, right? You know, out of curiosity, Oh, yeah, just another proof of the lack of significance of, Fibonacci ratio retracements. Just arbitrary stuff. Arbitrary stuff. Hey, look at that. You got a peak right there at that 50% fib retracement. Oh, man. I wonder which one I would trust more. The probability distribution or the retracement line. The arbitrary retracement line. Let's keep on going. Man, it's taking a while to... That whole PDF loaded faster than this website. What's going on with that website? ASB Economic Forecast Update. This is around the New Zealand economy. Global growth and export outlook. New Zealand's key trading partners are set to record a similarly paced 2022. 2024 is likely to be slightly slower. The weight of high interest rates is still making its presence felt in much of the developed world. The US and Europe face the prospect of sub 1% growth in 2024. Across the Tasman, Australia is still on track to grow, though in part through its net migration surge. China's prospects have been trimmed to around 4.5% for 2024, slight deceleration from around 5%. The recovery in tourism is fairly advanced from the Australian, American, and European markets. Recovery in visitors from Asia is still lagging. This is all New Zealand household stuff. It's actually important to read this stuff to get a decent set of expectations for RB and Z meetings, because a big factor for RB and Z rate decisions is the New Zealand housing market. Let's see here. Meanwhile, the housing market continues to find a base. Prices have risen for much of the past 6 months, as the median of days taken to sell a house has dropped sharply back near the long-run average. Inventory on the market has edged down, aided by low levels of new listings and an uptick in turnover. We expect prices to lift 7% for houses over the calendar year 2024 and strengthen further over 2025 once interest rates come down. Migration is underpinning the market, and looming changes to the tax treatment of residential property investment may also nudge prices up. That tax treatment is in regards to the brand new government, and actually they talk about it right here. The brand new government in Australia, a right-leaning, a centrist right party, got into power in New Zealand, and they don't want to have as significant housing regulations as the center-left party. So this is now coming up in economic analysis of New Zealand's housing market. So let's see here. Three parties exercise great fiscal presence. Oh yeah. Any tax cuts should not make the RBNZ's job of containing inflation more difficult. They are also, I think, removing the employment mandate from the RBNZ's mandate. I may not be remembering that correctly, but let's see if I am, if it comes up in here. New Zealand inflation outlook. Inflation is clearly on the way down. Inflation expectations are generally easing, reducing the risk of high inflation changing behaviors. New Zealand dollar outlook. It has been our view since May of 2023 that the RBNZ has finished lifting its OCR, and that's their cash rate at the RBNZ for this cycle. Accordingly, we think that there is a high hurdle for future rate hikes, but in a well-worn refrain, the OCR is likely to stay high for longer. We don't expect rate cuts until early 2025. So New Zealand might have some interesting carry trade opportunities if that's the actual case, no? We expect the New Zealand dollar to range around, well, NZD, USD, to range around the 60-cent handle before grinding higher over 2024 to 67. Central bank views, alrighty. Fed, they expect rates to stay on hold. Alright. BOE, left interest rates on hold. We expect, yeah, this is all just saying, hey, we expect everyone is done hiking, except for the RBA. Still risk of another 25 basis point rate hike in 2024. And here are some ASB foreign exchange rate forecasts against different currencies in the New Zealand dollar, quarter by quarter. So let's see here, June 2024 for New Zealand dollar at 64 and New Zealand yen at 83. So they're actually expecting yen to weaken against the New Zealand dollar going into 2024. Which you get that disinflationary inflation in Japan, and that causes the Bank of Japan to continue saying, oh, okay, we're going to have to continue our loose monetary policy because the inflation is not actually holding up at the level we originally anticipated from 6 months ago. Commodities weekly. Oh, this is all dairy stuff. I'll read that on my own time. Economic note. This is all housing stuff. We just went through that. This is Think ING on the ECB. Let's see, did this article load? Yep. Key points. At its December meeting, the RBA left rates on hold, but retained a tightening bias that was still relatively hawkish. However, our base case is that the RBA has reached its top and we'll see cutting rates in the second half of 2024. Gotcha. The risk of another rate hike, which, if it occurs, would most likely be at the next meeting in February after December. Quarterly data, which remains high. So if the December data does, the December quarterly inflation report for Australia does not come in significantly lower, that could induce the RBA to hike in February. So those rate hike expectations for February might be set in stone with data here in December. So we got to watch out on the Australian data here in December. But then again, understand that these are exchange rates, so there's another side to all these exchange rates. And if recession deals start to reaccelerate, come January, February, you could see that dollar and that yen get strong. Let's go ahead and check this out. ECB preview, long dovish shift. That looks pretty, yeah, this looks pretty much like exactly the same take as the Nordea expectations. And hey, this is the person who I think is taking up the seat at the RBA that the current chief economist of Westpac left open. I believe Ellis, who's at Westpac now, had this position before at the RBA, and now it's filled by another nice lady. Sarah helped establish the Americas, Asia Pacific, and Australian offices at Oxford Economics. And she was the chief economist there in Sydney. She was a partner at KPMG. Wow. Head of macroeconomic conditions at the Commonwealth Treasury. In her current role at Treasury, she oversees the analysis and current conditions and economic forecasts, advising the government on a broad range of economic and policy decisions. So this is a pretty heavy duty position. I'm honored and privileged to be joining the RBA. I'm very much looking forward to working with the governor, leadership team, and the RBA's highly skilled expert staff to serve all Australians. She starts at the end of January next year. Well, it'll be interesting to start to read some of her analysis and expectations on the Australian economy. We'll go ahead and skip that for now. We're almost at the end here, boys. We're almost at the end. Oh, yeah, this is actually some Bitcoin stuff that we're going into. Options traders are setting their sights on Bitcoin at 50,000 in January. Let's pull up BTC USD here. Yeah, we're currently holding on Bitcoin. Currently holding. And I agree with this risk of going higher. Let's see here. I'm looking for probabilities, the high, the pivots. So check this out. On this indicator, you clearly have a lot of your highs that come in right here, right? And that's currently where the high is on Bitcoin. But then you have this 14 up here, and that's at this R5 pivot. And this 14 is saying that's the probability of going above, just arbitrarily above that R5. So it's not like a non-zero chance here, even just based off the historical seasonal data from the last 14 years, that you get some sort of crazy move past 50. And understand that R5 pivot is priced at 49. And this article is saying, hey, 50. And then you go ahead and you bring up ARK Invest's monthly Bitcoin outlook. Let's go ahead and check this out. Hodlers remained steadfast as demand for Bitcoin grows globally. Investors anticipate monetary easing in response to deteriorating economic conditions. So let's go ahead and check out this one. This text is on the smaller side here. Long-term holders continue to hoard Bitcoin. So essentially, there's not enough selling going on here. People are getting excited for the halving. And I think maybe people are getting a bit excited for the halving a bit too early, in my opinion. Look, just because Bitcoin can have really crazy parabolic moves in one direction doesn't mean it can't occur in the opposite direction and just chop you out insane. Also understand that Bitcoin still isn't the most regulated market in the world out there, and you can have quite a lot of shenanigans. I mean, these are some pretty big moves, guys, remember. So you can, this has already been an insane move, right? This move can just continue. It can just continue. So it's like, yeah, it's about not putting all your eggs in one basket and also being aware of how quickly this stuff can flip on a dime. It's not easy, not the easiest thing in the world for people to discretionarily make trade decisions on Bitcoin, that's for certain. Well, I think with all that said and done, I am pretty much said and done. I'm going to be hanging out in the Discord if anyone wants to chat with me about some trading related stuff. I'll just be chilling in the trading room. with that all said and done, thank you guys for watching the stream. This one was a bit on the longer side. I mean, last stream was like 2 hours. This was like 1 hour and 15. So, thank you guys for watching. And I'll see you guys in a bit.